Hello everybody, it's Jerry Seville from Acorn Wealth here, and this is the first executive summary of 2015. Hope everyone had a wonderful break and are ready to rock and roll. It's shaping up to already look like a great couple of months ahead in terms of trading volatility. Of course, in the S&P 500, we've had a series of significantly down days. We've talked repeatedly about the importance of open range. Of course, we set the open range on Friday, January 2nd. The high was 2072, the low was 2046. So the key here was, will we close lower than that on volume? And today we saw exactly that. The volume picked up from 2.7 billion yesterday to 3.8 billion, closing confidently below that open range. So this is a warning that we are looking for a down market for at least the next couple of weeks until options expiration next Friday. You can also see that we've had significant divergence on the money flow. So this lower high on the Triggers money flow is showing us that money has come out of the market, and this Christmas rally was being used potentially purely as an exodus for the smart money. So looking at where the S&P levels currently are at, if we look at the Fibonacci retracement on the S&P 500, which illustrates the important points or the critical points the market could retrace to, you can see that the S&P 500 pulled back to its short-term 61.8 Fibonacci at 2019. So we could get a little bit of a possible dead cat bounce, or a bounce off this level, taking us up to the 2040 level or somewhere around that. That would be great for attacking on new shorts. We also could just continue to drop, and the next levels, of course, if you just get this one out of the way, we're looking at is a support point here at 2000, which is another 20 points down. Now, if we take that Fibonacci away and look at the longer term Fibonacci, we can just pull that off. Again, you can see that we've got that 38.2 at 1988, and the 61.8, which is commonly a critical level, you can see comes in around here at 1927. So these are the two levels I'm looking for, that break of the around that 1988 to 2000 level. And then if we break down further from that, I'd be looking at 1927 as the next target. So for the moment, I am biased to the shorts. I still hold long positions in things like FireEye and CYTX that I feel have their own kind of story going on. But in terms of looking at some new potential shorts, I found three that made my watch list for today. Now, I'll just bring them up on the screen. Here they are: HBI, CSX, and CNHI. So I'll go through those. Now I have to look at HBI first. You can see that this company has been in a potential head and shoulders formation, a narrow one, since back here on October 21st. We've got that left shoulder, the head, the right shoulder, and then this looks like, you can see the volume picked up from 597,000 from 478, 630 on Monday, and that head and shoulders would anticipate a drop here from that 107.89 level down to the support at 101, which is also where that previous support has been from the rally in October. So I've got an open order on this to short this around the current price, around 107.90 down to 102.34, and I've got my stop loss up at 111.32. So I'm looking for this one as I've got an open order to fill tomorrow on this. The next one, again, you can see that diverging money flow, which is exactly what we want, showing us that even though it's at the same higher than the price it was back here, there's actually a lot less accumulation and, in fact, distribution going on. The next one is CNHI, and this is also something that I have an open order on, looking to short this at 770 down to 713, so it needs to rally back up. But you can see this has been in a kind of bit of an awkward channel. You can see the parallel nature to those two lines, and it's as we know, channels generally revert to the opposite direction that they were previously moving. So this one has come up and is now broken south, and the volume here is 1.14 million over the 620,000 yesterday. So big drop. I'm looking for a small little rally, perhaps off that S&P support we talked about, and then a further drop down. And you can see that money flow also showing the same signs that we saw in the previous stock. And last but not least, CSX. Now, CSX, of course, is in the transportation industry, in the railroads, and if we look at what we possibly got here, we've got a descending triangle formation. So this is what I'm seeing here. We've had 1 touch, 2 touches, 3 touches. So I'm looking to short this if it breaks support, but ideally I'm looking to actually try and target off a rally. So if it can rally up to 36.16, I'll be looking to short it there, anywhere along this trend line, or a break of this support. Now you can see the money flow is in really negative territory here. So either a rally up or a break of support are the 2 triggers I'm looking to get in on that one. And in terms of a target, looking at an extension of this could be a drop all the way down to 31. So it offers about a, depending on where that entry point may trigger, it brings us down actually almost exactly to that support point of that previous candle, which is at $31. So you can see the kind of jigsaw puzzle fitting together. And again, this is a play off the weakness that we've seen in the Dow Jones Transport, which dropped significantly more than the S&P 500 did today, as you can see here in the graph. Possible double top. And you can see this drop. The Dow Jones Transport was down 2.66% on 18 million versus the 13 million yesterday. And that's, of course, shares we're talking about. Okay, so I hope that helps. We've got a great season ahead of us. So again, Happy New Year, everybody, and I look forward to seeing many of you in the trading room. Take care and happy trading.